In recent years, prices of everyday items have been steadily increasing, leading to concerns about the possibility of a major inflationary period. Inflation refers to a sustained rise in the general price level of goods and services in an economy over a period of time. It is measured by the Consumer Price Index, CPI, which tracks the prices of a basket of goods and services in a given economy. The current level of inflation is a cause for concern, as it affects the purchasing power of consumers, reduces their standard of living, and can even lead to a recession. There are several factors that are driving inflation higher. Firstly, the COVID-19 pandemic has caused supply chain disruptions, leading to a shortage of certain goods and services. This has led to price increases for these items. Additionally, many businesses have increased their prices to recoup losses from the pandemic, leading to a general rise in prices. Another factor contributing to rising prices is the recent global monetary and fiscal policy. Central banks and governments around the world have been injecting large amounts of money into the economy to support their economies during the pandemic. This has led to an increase in the money supply, which in turn has led to inflation. Furthermore, rising demand for goods and services due to an improving global economy is also contributing to inflation. As economies recover and people have more disposable income, they are spending more, driving up demand for goods and services and leading to higher prices. In addition to these factors, a weak U.S. dollar is also contributing to inflation. The U.S. dollar has been losing value against other major currencies, leading to higher import prices for goods in the U.S. As a result, the prices of imported goods have been increasing, leading to higher overall inflation. It is important to note that while inflation is currently rising, it is still below the 2% target set by the Federal Reserve. However, there are concerns that inflation could spiral out of control and lead to a major inflationary period. If inflation gets too high, it can lead to a decrease in consumer spending and investment, which in turn can lead to a recession. In order to combat inflation, central banks and governments around the world have several tools at their disposal. They can raise interest rates, which reduces the amount of money available for spending and investment, leading to lower demand for goods and services and reducing inflation. Additionally, central banks can reduce the money supply by selling securities, which reduces the amount of money available for spending. However, raising interest rates and reducing the money supply can also have negative effects on the economy, leading to a decrease in economic growth and even a recession. As a result, central banks and governments need to strike a balance between reducing inflation and supporting economic growth. The current trend of rising prices is a cause for concern, and there are several factors contributing to inflation. While central banks and governments have tools to combat inflation, they must also consider the effects of their actions on the overall economy. It is important to keep a close eye on inflation and to take appropriate action if it begins to spiral out of control. In order to prepare for the potential rise in inflation, it is important for individuals to take steps to protect their finances. Here are some tips to help you prepare. Save money. Building an emergency fund is crucial in case of an economic downturn, as it can help you weather unexpected expenses and provide a safety net if you lose your job. Pay off debt. High levels of debt can make it difficult to manage expenses during a period of inflation. Try to pay off as much debt as possible, especially high-interest debt like credit cards. Invest in assets that hold their value. Consider investing in assets such as real estate, precious metals, and stocks, as these can hold their value during times of inflation. Diversify your investments. Diversifying your investments can help reduce the risk of losing money in case of an economic downturn. Consider investing in a mix of stocks, bonds, and other assets to spread your risk. Consider inflation-linked bonds. Inflation-linked bonds are a type of bond that provides a return linked to inflation. These bonds can provide a hedge against inflation, as the return on the bond will increase in line with the rise in inflation. Shop around. It is important to shop around for the best prices on goods and services, as prices are likely to increase during a period of inflation. Compare prices at different stores and online to find the best deals. Plan your expenses. Make a budget and try to stick to it, as inflation can make it difficult to manage expenses. Plan for the long term and consider how you will manage expenses if prices continue to rise. The rise in prices is a cause for concern, and there are several factors contributing to inflation. While central banks and governments have tools to combat inflation, it is important for individuals to take steps to protect their finances. By saving money, paying off debt, investing in assets that hold their value, diversifying investments, considering inflation-linked bonds, shopping around, and planning expenses, you can be better prepared for the potential rise in inflation. It is also worth noting that there are some who believe that inflation may not be as much of a concern as it is being made out to be. They argue that the recent rise in prices is due to temporary supply chain disruptions caused by the pandemic, and that prices will eventually return to normal once the disruptions are resolved. Additionally, there are those who argue that the current level of inflation is not high enough to cause significant harm to the economy. They argue that a moderate level of inflation can actually be beneficial, as it can encourage spending and investment, leading to economic growth. However, it is important to remember that inflation can be a double-edged sword, and that too much inflation can lead to significant harm to the economy. As a result, it is important to keep a close eye on inflation and to take appropriate action if it begins to spiral out of control. It is also important to remember that the impact of inflation is not felt equally by all individuals. Low-income individuals and those on fixed incomes are likely to be hardest hit by inflation, as their purchasing power decreases as prices rise. To address the issue of unequal impact, governments and central banks can implement policies that provide support to low-income individuals and those on fixed incomes. For example, they can provide tax relief to these individuals, increase subsidies for essential goods and services, and provide support for education and training to help them increase their earning potential. In conclusion, the rise in prices is a cause for concern, and there are several factors contributing to inflation. While central banks and governments have tools to combat inflation, it is important for individuals to take steps to protect their finances. By saving money, paying off debt, investing in assets that hold their value, diversifying investments, considering inflation-linked bonds, shopping around, and planning expenses, you can be better prepared for the potential rise in inflation. Additionally, governments and central banks can implement policies to help reduce the unequal impact of inflation on low-income individuals and those on fixed incomes. By working together, we can reduce the potential harm caused by inflation and ensure a more stable and secure financial future for all.